Welcome back to Talk Tickers. Today we're digging into US Foods, ticker USFD, and their Q3 2025 earnings call was a real head-scratcher. It was what we call a textbook beat and raise quarter, but the stock tanked 4%. So let's break down what in the world happened.
So yeah, this is the big puzzle we're going to solve today. You've got US Foods firing on all cylinders, right? They beat the Wall Street estimates, and then they told everyone the rest of the year is going to be even better. And the market's reaction? A big thumbs down. So our job here is to figure out that disconnect. Okay, so first, let's talk about the good stuff. And there was a lot of it. Let's start right at the bottom line. Adjusted earnings per share. They hit $1.07. Now, Wall Street was looking for about $1.03, so that's a nice clean beat right there. And you know, that 107 number isn't just about beating the estimate. That's almost 26% growth compared to the same time last year. I mean, that is some serious growth. It really shows you how well they're managing the business.
And it wasn't just earnings. The strength was really across the board. You can see it here. EPS, beat. Net sales, beat. Adjusted EBITDA, up a solid 11%. And this is a big one. Total case volume was up over 1%. Now in this business, that's a huge deal. It's like the lifeblood. So yeah, on paper, you're looking at a pretty much flawless quarter.
And this really shows you how confident the management team is feeling. I mean, they didn't just crush the quarter and call it a day. Nope. They turned around and said, hey, we think the rest of the year is going to be even better. They bumped up their EBITDA forecast and gave a huge lift to their earnings outlook. That, my friends, is exactly what a beat and raise is all about.
All right, so how did they pull it off? Let's get into the nitty-gritty. So, what was firing in the engine room this quarter? Well, it really boils down to four key things. 1, they're just gobbling up market share, especially from the smaller guys. 2, they're being super disciplined with their margins, which is awesome to see. 3, they're making these smart little tuck-in acquisitions like this Shetakis deal to get stronger in key markets. And finally, man, they were buying back their own stock like crazy. We're talking $335 million in just this one quarter.
And listen to what the CEO, Dave Flippman, had to say. He pointed to that double-digit profit growth, but the real key here is what he said about independent restaurants. He called it a notable acceleration in case growth. Now, why does that matter? Because those independent restaurants, that's their cash cow. That's their most profitable business. So seeing that accelerate, that's a huge green flag.
And if you look at where that volume growth is coming from, it really tells you the whole story. Look at this. Independent restaurants and healthcare, both up nearly 4%. That's where they want to win. And yeah, you see that dip in chain? That's actually on purpose. They're walking away from business that just isn't profitable enough. It's a classic case of a company knowing its strengths and doubling down on them.
Now this is interesting. Management dropped a pretty big bombshell about a strategic change they're making. They're completely overhauling how they pay their sales team. They're moving to a model that's 100% variable comp. The whole idea is to get their salespeople laser-focused on selling the most profitable stuff. More independent cases, more private label brands. It's a bold move for sure, and you can bet the market is going to be watching to see if it pays off.
Okay, so we've laid out all the good news, right? The beats, the raise, the strategy, it all looks great. Which brings us right back to that big, nagging question. Why on earth did the stock sell off?
I mean, just look at this disconnect. It's absolutely wild. You've got earnings growth rocketing up 26%, and at the same time, the stock price falls by over 3.5%. What this tells you loud and clear is that the market was looking past these great numbers and seeing something else it didn't like.
And the whole thing gets even weirder when you put US Foods side by side with their biggest competitor, Sysco. It's like a tale of two different worlds. US Foods is raising its guidance. Sysco just cut theirs. US Foods is seeing positive volume. Sysco is seeing declines. It's crystal clear that US Foods is eating their lunch right now and stealing market share.
So what gives? Why the sell-off? Well, after digging in, it looks like it's a mix of a few things. First, you've got those big, scary macro fears. People are worried about the consumer, about a potential government shutdown, all that stuff. Second, some folks were probably just taking profits. The stock had a great run up to its all-time highs, so it was an easy time to sell. Third, there's been some chatter in the media about a possible merger with Performance Food Group, and that kind of uncertainty can spook investors. And finally, the trading volume was huge, like double the average. That usually means the big fish, the institutions, were the ones doing the selling.
All right, so you've got this amazing execution on one side and a whole lot of market anxiety on the other. So where does that leave us? Let's get to our final take.
So before I give you our rating, I just want to quickly define what we mean by market perform. Basically, it means we think the stock's going to do about as well as the overall market, like the S&P 500, over the next year or so. It's not a knock on the company at all. It just means that while the company's doing great, there might be other things like its valuation or bigger economic worries that could hold the stock back.
So here's the Talk Tickers call. We're rating US Foods on market perform, and we're setting our price target at $88. Here's why. You simply cannot argue with their execution. It's best in class, and they are clearly gaining share. But, and this is a big but, the stock's valuation is pretty rich, and you can't ignore that macro uncertainty. It really feels like a tug-of-war between amazing company fundamentals and a very nervous market, which we think will probably keep the stock in a holding pattern for a while.
And that really sets up the key question for the next quarter, doesn't it? Can this incredible operational excellence continue to win out against the pull of macro gravity? You have a company that's doing everything right, but a market that's afraid of its own shadow. That's the real battleground, and that's what we'll be watching.
And as always, just a reminder, this is not financial advice.